Hello and welcome to the Global Derivatives webinar, the very first of our new webinar series. I'm Victoria Chatterton, the Portfolio Director for the Global Derivatives Conference. I'm standing in for Ed Stapley. We'll also be live tweeting this webinar, so you can join the conversation using the hashtag GDWebinar. So, what are we talking about? Well, a contingent convertible, or Coco bond, is a high-yield debt instrument that converts into equity or writes down as soon as the issuing bank gets into a life-threatening situation. The exact trigger is typically in terms of a capital ratio and is often accompanied with a regulatory trigger. Today, we will grasp an overview the basic features of the anatomy of such bonds. We elaborate on the main risk embedded in these instruments and discuss a couple of methodologies to price and manage the risk of Coco bonds. We're joined on the line with Wim Schoutens, Professor of Financial Engineering at University of Leuven. Welcome, Wim. And before I hand over to him, I would just like to remind you that we'll be holding an interactive Q&A after the presentation. So if you have any questions during the presentation, you can send them to us using the Ask a Question button at the bottom of the screen. Right, over to Wim.
Okay, good afternoon, everybody, at least good afternoon for me. Let's talk about Coco bonds. They have been around now already for about 6-7 years, and the market has been growing and growing. And let's have a look at the risks in these kind of high yield bonds. Everybody knows that if there is a high yield, there is serious risk. And so what is this risk? The Coco bond can convert into equity or write down the notional as soon as the bank gets into a life-threatening situation. And that's the main risk. You can lose your notional or you can be converted in equity, which will probably be worth very little. And hence, there is a serious downside. When is this happening? Well, this kind of conversion or write-down happens when a predefined trigger is met, and this trigger is typically in terms of a capital ratio. For example, the Common Equity Tier 1 ratio falling below 7%. Then the Coco automatically triggers or write down, and the investor faces a serious loss. Often this kind of trigger is also accompanied by a regulatory trigger, which makes the modeling even more difficult because the regulator, no matter where your capital ratio is, can decide that on the basis of his information, the bank or the institute is in a kind of a troubled situation, and he can decide that to trigger the Coco. And hence, there are serious risks, and intuitively, you already see that there should be a high yield attached to these kind of instruments. Well, if such a kind of bond is converging or writing down, well, this creates dilution for the existing shareholders. But the idea of creating these bonds was to protect potential taxpayers. So the bonds add another level of loss absorption for troubled banks. Cocos are issued as bonds, they pay coupons, but the more the bank is in trouble, the more the Coco starts behaving as equity, and that's challenging from a kind of modeling perspective. If we look to the life of a Coco, well, on normal times it pays a high coupon, and we come to a redemption, and then most likely, in many cases, there will be a new issue because these are capital instruments. However, if the bank comes in a distressed situation, as explained, either by a regulatory trigger or by an accounting trigger, the bondholder becomes shareholder or the bond is partially or fully written down. Well, how does a Coco looks like? Well, typically the maturity is more than 5 years. Actually, it needs to be more than 5 years because otherwise it doesn't count in the capital, at least in Europe. There are two kinds of bonds, additional Tier 1 bonds and Tier 2 bonds. Tier 2 bonds typically have a fixed maturity. Additional Tier 1 are contractually a perpetual, so no fixed maturity, but there is a call date. The call date is typically more than 5 years. Very important to note is that there is no incentive to redeem. In old hybrids, there was typically a step up, which was a kind of a punishment if the issuing company was not repaying the bond. And therefore, he was typically, or he had an incentive to call the bond at the first call date. This is no longer true for Coco Bonds, and hence there is a serious risk of not getting your money back at the first call date. We call that extension risk. We see that Cocos have typically high coupons and that there are trigger events, and also important to note is that there is possibility of coupon cancellation, especially for the additional tier 1s. The bank or even also the regulator can decide that that year or that kind of period no coupon is paid, and that coupon is then lost forever. This is also a serious risk because losing a 7 or 8% coupon, that's quite significant loss on your investment. So we have different loss absorbing mechanisms. On one hand, coupon cancellation, on the other hand, the conversion or write-down mechanism. The write-down mechanism, that is pretty straightforward. If the Coco triggers, you lose your notional, no coupons are paid anymore. Or you partially lose your notional and the bond terminates. Examples are the partial write-down Coco of Rabo. Full write-down Cocos are all over the place. Barclays, KBC, Credit Suisse have issued these. The conversion mechanism is a little bit more involved, and there it matters at what kind of price do you get your shares. There are different possibilities. The share price can be the price of the underlying stock at the issue date of the Coco, or can be a fraction of that issue date, or can be a more complicated formula with the floor involved. This conversion price is essential in the modeling, and it basically determines the recovery rate of the Coco. A recovery rate of a full write-down Coco, that is easy, that is 0%. But there is a recovery rate, a non-zero recovery rate for conversion Cocos. How much? This is part of the modeling and not always easy to estimate. We see that Cocos have been having an exponential growth since 2013, and many banks, especially in Europe, but also a bit in Asia and in Australia, have issued them. The Coco market currently has a size of almost $200 billion, and so is becoming quite significant. From where is the 7% yield coming? Well, here is a simple breakdown of the yield. There is a risk-free interest rate component, but nowadays this is typically small, and therefore I attach to it a range of 0 to 200 basis points. There is, of course, also the conversion component. This is the main risk. You can lose your notional. And in my graph here, a wild estimate is showing 300 to 600 basis points. If you add on that some risk for the coupon cancellation, some risk for the extension risk, and potentially some liquidity component, because these bonds, although in good times often quite liquid, we expect that they will lose their liquidity in kind of more difficult times. And if you then do a simple sum, we see that the coupon adds up easily to the ranges of 700 to 800 basis points. How to model this? Well, there are different models, and also in academics there are nowadays more and more papers written about it, but I see three basic models. One model is a kind of rule of thumb modeling. It's coming from credit derivatives, a simple credit triangle or LGD-PD rule, where the Coco spread is 1 minus the recovery multiplied with the probability or the trigger intensity. How to estimate that? Well, pretty similar as in kind of credit markets. Another approach, a little bit more sophisticated, looks to the Coco as an equity structured product, where we model it as a kind of structured product which has exactly the same cash flows as the Coco bond, but where the trigger is not determined in terms of an accounting trigger or a regulatory trigger, but is simply determined by a stock price hitting a low barrier or not. And using that, we are back into equity land, and we can use plenty of models and formulas that has been developed in equity modeling. Quite recently, we also came up with what we call a Common Equity Tier 1 model, where basically we look to COCOs as derivatives on some level, the Common Equity Tier 1 level. And we model dynamically the Common Equity Tier 1 model by a kind of black model, and the implied volatility is basically the driving parameter, and we try to estimate that driving parameter from the market. Like a European call option, out of that you can easily reverse engineer. Here we do something similar. From the COCO market price, we reverse engineer an implied Common Equity Tier 1 volatility. And surprisingly, if we do that and we look to the markets, what we see is that COCOs of the same issuer typically have implied volatilities around the same level. But of course, not every issuer is the same. And here on this graph, you see the wild spectrum of a bunch of COCOs and their implied volatilities and how they behaved over time or since they were issued. Coming to a conclusion, I'm basically saying COCOs are nice, new, interesting instruments, but they bear a lot of risk. There is conversion or write-down risk, there is coupon cancellation risk, there is extension risk. The modeling is not straightforward because these kind of risks are not easy to quantify. It's also not easy to always, but there are ways to model these using sophisticated or simple underlying stochastic models. You find some additional references here on this list and also in a book that we recently published. Thank you.
Fantastic. Thank you so much, Wim. Really interesting stuff there. So I've got a couple of questions that have come in, and I just wanted to put them to you if that's all right. So the accounting triggers of especially additional Tier 1 COCOs are often quite low, so around nearby 5%. Are these levels not too low?
Well, many market practitioners think indeed that the COCO will be converted earlier than the 5% level, than when Common Equity Tier 1 is at the 5% level. And this is due to now to estimate exactly when these are regulators are going to trigger a COCO. That is, of course, not so easy. But some rough estimates show that we are talking about levels closer to the 9% than to the 5%.
Okay, interesting. And is this a more European story, or are we going to see Coco bonds all over the world?
Well, for the moment, it's a European story. But also in Asia, we see issues of Coco bonds. It's European because it's in the new regulation for the banks in the CRD4. America is not so Coco-minded, and but we'll see what's happening. But I believe they will be here for the remaining time. And well, of course, the 1 billion question is what will happen when a COCO will trigger.
Interesting. Okay. And another question I have here is, of the risks that you mentioned, which do you believe is currently the most underestimated risk?
Well, there are many underestimated risks because I think the coupon cancellation and the extension risk is something that people in good days don't really think about. But now, and especially in these days where Deutsche Bank is under pressure again, some people rethinking again it, and I think there is serious risk that coupons can be cancelled on these instruments.
Okay, that makes sense. And then, from the point of view of investors, what are the benefits of COCOs?
Well, some say COCOs are basically having the downside of equity and no upside. I don't agree. You get an extreme high coupon, and 7-8% is on average the equity return, and you get that without any volatility. And you get that in return for a downside, but this is a serious downside. So the bet is clear. If you don't believe we are going into a next financial crisis, then a COCO gives you a long-term equity return without any volatility on that return.
Okay, thank you. Got a fair few more coming in as well, actually, which is great. So to use the rule of thumb model by applying CDS spreads seems to underestimate risk significantly. Would you agree to this? Would you agree with this? And also, is CDS really applicable given the large bank cannot default under the BRRD?
On one hand, I agree, because this is just a rule of thumb. This is just to see where the order of magnitude is, but in the rule of thumb, there is no coupon cancellation and extension risk taken into account. Giving a large bank cannot default under BRRD. Well, of course, we are not modeling it like a CDS, but there is a whole discussion of too big to fail also involved. But I think COCOs are a little bit further away from this kind of too big to fail issue, and they are created by regulators and potentially also triggered by regulators, especially to prevent a large bank going into default.
Fantastic. And are there any parallels to the guaranteed investment or insurance products that we see out there, such as variable annuities?
Some parallels in the sense that on one hand they also have often high coupons. On the other hand, the underlying quantities are not easy to model, and common equity one is not kind of observable, and kind of variable annuities, that's not easy to really observe how the underlying things behave.
Okay, I see. And you mentioned that COCOs were developed to protect taxpayers. How does this protection work?
Well, if the COCO triggers, then on the liability side, the bank doesn't have to pay back this debt. And that is pure loss observing. In a conversion, you get a much bigger equity base, and hence what was not possible. That's a little bit the reason why it was created. One has noted that in times of serious stress in the markets, it's not easy to go to the equity markets and raise new capital. These instruments do that automatically via a predetermined contract and formulas in case of stress.
I see. And what do you think about the hedging consequences of COCOs?
Yeah, well, hedging COCOs, it's not easy, but you need models for it, and that's why we have been dealing with these models and trying to set up models. Hedging is not easy because we have negative convexity and negative gamma, and this is tricky, and this is all related to the debt spiral effect. And I can talk hours about that, but the hedging of COCOs is not easy. It is essentially done by either shorting equity, and that's of course difficult thing to do in stressed markets.
I see what you mean. How would you model extension risk in an equity model? Sounds like quite a technical question.
We have a paper about that, where we basically model the spread of a Black's model and see whether the spread at call date is above or below initial spread. If it's above, then the Coco will be not paid back and will be extended. If it's below the initial spread, it's good for the issuing bank to redeem and issue a new Coco at a lower spread. So that's a little bit the model in a nutshell. But okay, there are possibilities. It's not easy, but it's doable.
Okay, and what about recovery rates of temporary write-down Cocos?
Yeah, I believe they are zero. I know that they can be written up again, but I think the probability that they will be written up again in a reasonable amount of time is extremely low. So I made myself comfortable with just putting a zero recovery rate in.
Okay, that makes sense. And I've got a couple of questions regarding the types of investors. So firstly, who are the main investors of Coco instruments? And secondly, could Cocos be sold to retail investors?
Well, several regulators have either forbidden it or have made it very difficult to sell Cocos to the mainstream retail investors because they believe that these instruments are sophisticated and have several risks with them that a kind of retail investor not typically understands. And this together with a kind of a high issue amount, typically 100 or 200,000, makes it not so easy for the man in the street to easily buy them. On the other hand, who is then buying them? Well, asset managers, family offices, more sophisticated players, also insurance and pension funds, because in an extremely low interest rate environment, these institutes that I mentioned are all looking for yield. And here you have an instrument giving you 7-8% coupon. Of course, it comes with a risk, but if you are willing to take that risk, it can be an opportunity.
And I've got some other questions coming in from a bank perspective now. Can banks buy Cocos from each other?
Yes, but it's not in their kind of. They have to put quite an amount of capital against that, so they don't have an incentive to buy that much of each other, which is good because otherwise you have a kind of contagion, and we know what with the contagion and systemic risk things can happen.
We certainly do. So if a bank can cancel a coupon at their pleasure, or when they want to, what prevents them from doing this?
Well, that's if you mess up with your investors, it will be very difficult to go to the capital markets again and raise capital. So on one hand, of course, they want to be friendly towards the market because they will need capital, and this is a capital instrument, and they need capital for many years in the future. So from the moment that you do that, you know that you basically shutting yourself off the capital markets for a serious period of time.
Well, that makes a lot of sense. What also about all Coco bonds are different, so isn't there a need for a standardization of these bonds?
That would be nice to have standardization, and the EBA has made a small attempt towards a standardization, but for the moment we are not there. But it would be nice, and it would bring, I think, a little bit more transparency to the market.
And do you think the market's going to continue to grow?
Yes, I think so, because there is still room for many banks to issue Cocos, and Cocos are part of the capital structure, and they up to 1.5 or 2.5% of the risk-weighted assets can be filled into Cocos in Europe, in Switzerland even more. And the alternative is issuing equity, and that's more expensive for banks. So I think there is still room of seeing a kind of increase in the markets in size.
And also, are you able to comment on the latest price evolution of cocos and bank stocks? So looking at the different nationalities of Italian, German, etc.
Yeah, well, if Deutsche Bank's equity goes down, then the cocoa goes down, and if banks are in stress, cocos will reflect the price evolution of cocos will reflect that, and equity will typically be hit more, but second in line are the cocoa investors, and so in terms of trouble, one sees quite some volatility on the cocoa side as well. But I think what we have seen in the recent markets is pretty along what kind of models predict.
And you said the regulatory trigger is more around 9%. Currently, the CET1 ratio of UCG is around 10.5%. What do you think about this situation?
Well, of course, the number I mentioned of 9% is a wild estimate, and is a kind of industry average estimate with kind of large error bounds on it. But yes, you see that some banks are becoming closer to this kind of situation, and this is how it is. I'm not saying that cocos will never be triggered, and cocos will or coupons will never be cancelled. Some banks will run into trouble, and then these things will happen.
I see what you mean. And how can you model the dilution in case of unpredictable conversions?
That's a difficult question. That's
Sorry.
I'll answer that one via email.
Sure, no worries at all. And what would be the consequences for cocos and in general for Deutsche Bonds if a coupon cancellation would take place?
Well, I think cocoa prices will go down significant because investors then really are reminded by the fact that they can lose their coupons, and losing a 7%, 8% coupon will be a significant loss. And for Deutsche Bank, it will just add to the trouble they are in. If they cannot pay their additional Tier 1 investors, then the kind of confidence in the company will be even more weakened.
We also have another question, which is, so is a cocoa just a kind of insurance for avoiding defaults?
Is it a kind of insurance?
Yeah,
for
kind of avoiding defaults.
It's a mild insurance of the regulators, but it will not prevent defaults. It will just help a little bit in preventing it, but it cannot exclude defaults.
Okay, well, fantastic. There was a fair few people have actually asked you what's the title of a book that you recommended. They didn't quite catch the title and they want to hear it again. So what was that?
Okay, so it's a book issued at Wiley, and the book is called The Handbook of Hybrid Securities, Convertible Bonds, Coco Bonds, and Bail-in. But if you Google my name and look for Wiley and Handbook Hybrid Securities, you will find it.
Fantastic. That's really useful. Thank you, Wim. Right, well, we're actually out of time. That was a lot of questions, and I'm afraid I haven't been able to send them all to you. But thank you so much for taking the time. You've clearly ignited a lot of debate, and there are a lot of questions that need answering. So hopefully you'll be able to talk some more about it at the Global Derivatives Conference in 2017, and we'll see you there.
Okay, hope to see you there as well. Thank you very much.
Thanks so much, Wim. Have a good day. Thank you, everyone.
Thank you. Bye.